There you go. It's a fundraise surge like no other. And to discuss and analyze what's fueling this surge in many ways, I'm joined by another panel of experts. We have with us Dhananjay Sinha, CEO and co-head of equities at Systematics Group, even as Sunil Subramaniam, market expert, joins us online as well. Gentlemen, thank you so very much for joining us on India Tonight. Mr. Sunil Subramaniam, if I can start with you, let me see if I get these numbers right. We've crossed 1 lakh crore rupees, to be precise, in equity fundraising in just a few months. What do you think, sir, is driving this surge? Is it a case of promoter confidence, robust investor appetite, relatively stronger markets? What is it really that's driving this surge in fundraising, Mr. Sunil?
So I think the first is that this is probably the waiting period for the private equities who have funded these companies through an early stage are looking to get a good return on their investment. So depending on the time of the investment, if they have achieved what their investors in turn, see, most of these funds have raised money from high institutional investors, right? So according to those return expectations, when they hit that bar that they feel this price can be absorbed by the market, they come out and sell because they owe a return of cash and to their investors. That's number one. The second point to this is that there is adequate domestic liquidity, that you said. You're seeing that a steady SIP book about 30,000 crores a month with a little more additional lump sum of about 5, 7, 10,000 per month means that over the past 9 months, you're talking about almost 4 to 5 lakh crores of money available with DIS. Third is that a lot of these placements happen in the broader market, which is in these small cap, mid cap spaces, right? Their liquidity is a key concern. So doing these block deals rather than coming out in an open market and crashing the prices. So invariably, you'll see that these offers are made at about between 2 to 7% discount to the prevailing market price because the investors also demand it. Because when the insider, the private equity or the promoter is selling, then they say that, oh, you know that the valuations are perfect, so then you leave something on the table for us. So I think all those things have come together in a way. In a way, it's healthy because otherwise, all of this money going into the broader market has been raising valuations there. You know, while large cap valuations are round about the long-term average and fairly reasonable, the mid cap and small cap are all trading at a premium to those large cap valuations. And so more and more money instead of going directly into those stocks goes through the QIP route. I think it's a healthy scheme for the market.
Right. You say that this is a healthy picture, but let me get in your thoughts, Mr. Sinha. Do you think this is a sign of corporate confidence, or are companies merely taking advantage of the super high valuations that we're seeing?
So I think it's a mix of multiple things. The previous speaker has spoken about some of them. I think if you look at the broader trend, one thing is very common over the last few years is that there has been a significant participation by the domestic institutional investors, and cumulatively there has been a humongous amount of purchases that DIIs have done. Let's say for the last 2 years, the incremental inflow from the DIIs into the market has been to the tune of almost like $150 billion. Over the last, let's say, 2 years or so, equity markets have actually given very flattish return. They have underperformed the GSEC, the risk-free rate itself. So essentially, what is happening is that during this period, you have exits happening from the FIIs. Cumulatively, over the last 2 years, there has been an exit of roughly about $56 billion. Market should have actually given a positive return. So the reason why the market has actually been very flattish is because there has been a significant increase in supplies from IPOs, from private placements, placements by block deals, etc., OFS, etc. So I think what is really happening is that the promoters and the companies are seeing that there is a certain amount of flattishness at this juncture. There is a certain amount of stability, or I would say there is a certain status quo as far as valuations are concerned. So whenever there is a rebound in the market, we find a flood of issuances tapping the market. When the market actually goes down, it goes away.
You know,
so essentially,
I mean, I
is
completely
yo-yoing.
get that rationale, Mr. Sinha, but the fact is that even as we speak, foreign inflows continue to be quite strained. So if FII sentiment continues its downward trend, does that make the pipeline of all of this funding that much more vulnerable?
So I would say that the FIIs have not been participating for several years now. I would say over the last 10, 11 years, there are a couple of years only when the FIIs have actually participated in a big way. Currently, the FII participation is at the lowest level. So essentially, it is the significant participation of retail investors in the equity markets directly and through institutional channels such as mutual funds, which has actually been holding up the market. Over the last few years, what has happened really is that earnings for corporates have actually been very modest. There is margin pressure, etc. So the fundamental reason for the markets to go ahead is fairly muted. And in the context that FIIs have actually continued to exit, in a context where the rupee has depreciated and real return is actually significantly negative, and with respect to valuation is actually expensive relative to the rest of the world, I would say that what domestic companies are doing is to actually make hay when the revival in sentiment happens. So I think over the last 2 years, you have seen various times the market has actually gone up and then come down. Whenever it goes up, there is a influx of issuances from corporate. So I think companies are using the intermittent rally as an opportunistic situation to liquidate. So I think if you look at the overall, almost like two-thirds of the demand is being met through the supply that is coming from the primary issuances from companies or OFS or block deals. So I think the remaining part is essentially giving exit to the FIIs.
Sinha? That's right, Mr. Sinha. Of course, and FII exits, well, that's another story that we're going to be talking to you about shortly. But let me come to you, Mr. Subramaniam. Can the fundraising momentum continue if markets turn volatile? I mean, what we've seen on the geopolitical front, particularly with respect to the West Asia war, there's been a lot of volatility. Do you think if this gets even more serious in the future, with Russia-Ukraine war also sort of turning volatile, will this momentum continue in the Indian markets? What do you foresee for the next couple of months?
No, I think the momentum will continue. See, you talked about FIs being negative, but if you take the most recent data, with the latest, escalation in the Iran-US war, you haven't seen FIs react very negatively. And if you see gently, and even today, I think FIs have actually been buyers. So what's happening is that the initial reaction of the war start in the month of March, right, was very negative. FIs pulled out, I think, close to 1.25 lakh crores just in that 1 month. Post that, if you see, it's been coming down. In fact, the month of July, I think the total negative was just 6,000 crores. So there's been a change in FI mentality where the worst on India has been discounted. So today, with the geopolitical scenario, even when the escalation happened, oil didn't go back to 110, 120. It went to about 90 and then has retraced back to 80 now. So I would say that given the fact that now this particular war doesn't look like it's going to be as long as the Russia-Ukraine war. And to that extent, I think that the Indian markets are in a stable. I'm not saying that they're going to gallop and rise now even further. For that, you'll need a lot more good news to come through. But I think that they have hit some kind of a bottom. So to that extent, I don't see that I'm worried that this volatility is going to hurt this. The second is that the very reason these block deals happen is because they don't want to go and test the open markets and have a lot of noise around it and affect the valuations. Whereas these are privately negotiated deals with about, like I said, somewhere an average of 5% discount to the prevailing price. And the private equity is not very often from outside India. So in a way, if you look at it, right, the public equity has started coming in terms of FII flows in the cash market. But on the other side, these private equity are taking these profits out and they're probably going and investing in some AI companies and somewhere else. So there's a rotation of capital around. And finally, on the FII thing, one thing if you notice is that the shorts, the index shorts have come down dramatically over the last 2 weeks. So it clearly indicates that FII sentiment is not as negative as earlier. So I hence apprehend that the volatility in the coming days would not be as heightened for us to worry. But these kind of block deals will continue to be there because it's far simpler from a cost of transaction perspective. You just talk to a few things, an investment banker arranges a few meetings, and you're done and quickly done with a bulk kind of a fundraising. So this will be continue to be a feature of the market. And one of the reasons for that is, of course, the liquidity in the domestic fund managers' hands. So these deals are also driven by the fact that the fund managers are looking for good places, good companies with tested track records to invest rather than just go buy out in the secondary market. So it's a win-win from both perspectives, right? The issuers themselves as well as the investors, because 50% plus of the SIP book is in mid and small cap funds. So that's why fund managers are forced to
Right.
go into that segment, and they would rather do that through a block deal with a very tested company with a good cash flow projection and stable business.
Right. So let me ask Mr. Sinha then, are block deals the most preferred mode of fundraising today, Mr. Sinha, as far as your observations are concerned? I mean, what we are picking up from the ground is that a combination of QIPs, offers for sale, block deals, IPOs, all are coming together for that fundraise party. But which of these is seeing the strongest demand, and why? Do block deals continue to stand out?
So I think every issuer or supplier of equity has his own objective. I would say block deals are in fashion. I think in terms of magnitude and number of issuances that are happening, I would say that block deals are higher in frequency. Essentially, these are investors, PE investors, etc., who have invested initially at cheap valuation, and they have sort of run through a certain phase of growth, I would say, over the last 4-5 years, and they want exit at good valuation, and there are good participation that is happening from the DII, so they get good valuation. I would say companies have also been, I would say, in terms of the IPOs, etc., these are large in quantum, in terms of value, and I would say in overall magnitude, they would be roughly equal to the OFS value. So I would say that companies are also tapping the market to raise equity funds. Important thing is that the block deals and I think OFS are basically an exit route with respect to the IPOs, etc. What companies do with respect to the fund that is raised is very important, whether that is going into capacity expansion or is it getting invested into another financial assets. We have seen companies investing abroad as well significantly over the last 4-5 years, rather than doing private capex and expanding the capacity, because they are also facing a certain demand scenario which is not very robust. We have seen that there are margin pressure that is happening across most non-financial companies. So essentially the incentive for companies to really invest that fund that is raised is something that is actually diminishing in the recent times. So I would say what it does is to really increase the capacity for companies to invest in financial assets and other assets. So and also companies have actually deleveraged themselves. They have good amount of cash balances on an overall basis. Over the last 5 years, there has been a significant increase in the operating profit till about 2 years back. So I think I would say that the eventual growth in earnings can happen if such fundraising goes into enhancement of productive assets. Otherwise, it is just an opportunistic scenario that companies and private equities are tapping into. And that is the reason why we have seen that over the last 2.5 years, there has been a fairly modest return for the retail investors who are investing through DIIs or directly. I would say a significant number of stocks that are in the mid cap and small cap in particular are still giving a negative return. So I think there is a certain amount of trade-off that the retail investors and DIIs would also need to consider going forward, because if
Absolutely.
you are actually performing less than the risk-free rate, and foreign investors are getting negative return net of the rupee depreciation, you need to be careful about how the flows will go ahead.
Right.
Yeah, so.
Absolutely. And these, Mr. Sinha, are going to be very important trends to watch out for in the near future. And whether there's going to be a short-term correction after the kind of boom that we're seeing in the markets as of now, that will be very interesting to watch out for. But on that note, thank you very much, Mr. Sinha and Mr. Subramaniam, for joining us and helping us decode this story and this trend that we are currently seeing in the markets. Thanks very much once again for joining us here on ET Now on India Tonight. And ladies and gentlemen, let's now take a look at some news that's coming in from the oil ministry this time.